Hey everyone, Jack Burdey from the Schaefer Financial team here at Canaccord Genuity. This video is going to be all about dividends. So starting off, what is a dividend? Why do companies pay dividends? Is it beneficial to own dividend-paying companies? What is a dividend yield? And should you chase dividend yield? Let's jump in. What is a dividend? A dividend is a distribution of company earnings to its shareholders, usually paid out by cash or by additional stock. After a company has paid all of its necessary expenses, it will return some or all of its profits back to shareholders via dividend. Why does a company pay a dividend? When you purchase a stock, you're buying a claim to the future earnings and prospects of that business. A dividend is just one of the ways the business can return those earnings to you. As I mentioned earlier, once a business has paid all of its necessary expenses, it can either pay out the profits as a dividend, or it can reinvest that money back into the business to grow. What it decides to do depends on a variety of factors, including the industry it operates in, its growth prospects, what stage of the life cycle it's at, its profitability, and more. Let's take a look at two very simplified examples. So let's say there's a hypothetical company, John's Manufacturing. There's 10 investors, each purchase 10% of the company. There's only 10 shares outstanding, so that means each investor owns 10% of the business and one share. Now, John's Manufacturing has net income of $15. Remember that I said that, that dividends are paid out of profits after deducting the necessary expenses. So if you have $15 profit, 10 shares outstanding, you have $1.50 per share to do what John's Manufacturing wants. So scenario one, John lives on a remote island. There's only a few customers who have the same demand. So even if you reinvest the $1.50 back into the business and builds more factories, it's not going to yield any sort of benefit for the company. In this case, it might make sense for John's Manufacturing to pay out 100% of their earnings as cash dividends, returning $1.50 per share back to shareholders. In scenario number two, John has many potential customers. There's high demand for the product, many growth opportunities. In this case, it might make more sense for John to reinvest that $1.50 back into the business. Let's say he buys a new factory. And the next year, he produces $30 in net income, earning $3 per share. As you can see, depending on the scenario or the type of company or whatever else, depends on how the companies may take their earnings and what they do with them, whether they distribute them as dividends or reinvest them back into the business. Are there benefits to owning dividend-paying companies? Yes, there are a variety of benefits, and here's a few. 1. Dividends can help generate consistent income on your portfolio. 2. Dividends can help weather the storm during market downturns and potentially help you reduce volatility in your portfolio. 3. In Canada, dividends are beneficial from a tax perspective in non-registered accounts. 4. Mature companies will tend to increase their dividend as they grow their earnings. This means that your yield on cost will increase over time. Warren Buffett's company, Berkshire Hathaway, has a cost base on their Coca-Cola shares of $3.25. Coca-Cola has increased its dividend for 61 consecutive years, up to an annual dividend payment of $1.84. This means that Buffett's company has a yield on cost of 57%. Obviously an extreme example, but you can see the benefit of having dividend-paying companies in your portfolio and holding for the long term. However, I'd like to note that just because a company doesn't pay a dividend doesn't mean that's a negative sign. For example, young companies or ones that have plentiful investment opportunities are better off putting those profits back into the business and growing rather than distributing it to shareholders. For example, Amazon has never paid a dividend. It focuses on expansion over distributing that money back to shareholders. And I don't think any Amazon shareholders that have held for the long term are upset about that. What is dividend yield? Dividend yield expresses how much a company pays out in dividends relative to its stock price. So let's say there's a company trading at $10 per share and pays a 50-cent dividend. In this case, the dividend yield would be 5%. Now, a dividend yield can change for one of two reasons. 1, the dividend paid changes, or 2, the stock price changes. Is it a good idea to chase dividend yield? No. This is because dividend yields and share prices have an inverse relationship, assuming a constant dividend. So if a company's share price starts to decline, but it continues to pay out the same dividend, the yield will look artificially high. Let's take a look at our example from before. Let's say John's Manufacturing has a stock price of $25. Well, in scenario one, that $1.50 dividend paid out divided by 25 gives you a yield of 6%. Now, in scenario two, assuming the stock price doesn't change, in the second year, the company could pay out $3 divided by 25, giving you a yield of 12%. Now, I know you might be thinking, $1.50 for 2 years, $3 for 1 year, what's the difference? Well, now, in scenario two, the company has the ability to continue to pay out $3 for the foreseeable future, or they can take that $3, reinvest in the business, and hopefully grow it again at a higher rate, continuing to compound the earning power of the company. Now, here's the risk of chasing dividend yield. Let's say in scenario three, the stock price declines from 25 to 15 due to a negative outlook on the future of the company. However, the dividend paid remains the same. Let's say $3 divided by a new $15 share price gives you a yield of 20%. Not bad, right? Well, if the money that you put into the business originally is now at risk because the company could be going through financial difficulty or bankruptcy, then all of a sudden that 20% yield doesn't look like that great of an investment. This is the risk of chasing dividend yield. That being said, dividends do play an important role in overall portfolio return. Chris and I tend to focus on total return when building portfolios. This includes both capital appreciation and dividends to achieve a rate of return that is appropriate for your portfolio. As always, I appreciate your feedback and I'm happy to answer any questions that you might have. Take care.